Good morning, good afternoon, good evening to all. We have quite a bit of material to go through today, so let's start now and we'll see how many people start joining us. But welcome to this first of two-part workshop on the Beps two-pillar solution. As you know, this two-pillar solution was agreed to by 137 member jurisdictions of the Beps inclusive framework in October of last year. Thank you very much for joining us today. We'll be focusing on the Pillar 1 package during this workshop. My name is Kaylin Onesco, and I am a public management specialist at ADB. I'm also a member of the Asia Pacific Tax Hub Secretariat. I'm joined today by two other ADB colleagues. Let me turn the floor over to Renata for a quick introduction. Thank you.
Thank you, Kaylin. Good day, everybody. My name is Renata Fontana, and I'm the project leader for the Regional Technical Assistance Initiative on Enhancing Tax Transparency for ADB Developing Member Countries, and it's a pleasure to be here today with you. Back to you, Kaylin.
Thanks, Renata. Before I turn the floor over to Matthew Andrew, who will be leading today's discussion, let me just go over the House rules. Danny, can you please shift to the next slide? So this meeting is being recorded. An email will be sent to participants following this workshop, which will contain a file that has this recording along with a copy of the slides. Second, please remember to rename yourself as shown on the screen. So put your jurisdiction or your organization followed by your first name and last name. This is important in case we need to follow up with you with any outstanding questions. So please remember to rename yourself. If you have any problems doing so, please contact our IT team, Danny or Tony, who can help you with that. Next, please remember to keep yourself on mute. If you have any questions during the presentation, please type them into the chat and we will respond to those questions during the question and answer session, or if we run out of time, we will contact you following this workshop to respond to your question. If during the question and answer session you wish to speak, please use the raise hand button and we'll call on you and invite you to take the floor. And then finally, at the end of the workshop, we'll have a survey that we kindly ask you to complete to give us your feedback on this workshop. And as email will also be sent to you with a link asking you to fill out the survey. So without any further ado, I will turn over the floor to Matthew. Matthew is one of our experts on Beps. So over to you, Matthew. Thank you.
Thanks very much, everyone, and appreciate the opportunity to update you on Pillar 1. As mentioned by Kaylin, we have a lot to get through, so we'll get straight into it. Next slide, please. So in terms of this, I'm going to take you through an overview of the timeline and also what Pillar 1 actually is, its constituent parts, and then we'll go through each part component of Pillar 1, and particularly Amount A, and then we'll finish with what's next for that, and then we'll move into a question and answer. Next slide, please. So what is the status of Pillar 1? Let's move to the next slide. As you can see on this slide here, this outline provides a timetable in relation to both Pillar 1 and Pillar 2, specifically in connection to what's happening in 2022. We'll go to the left-hand side of the slide, which deals specifically with Pillar 1, and that's what I'll be focusing on today. And as you can see from this slide on Pillar 1, there has been a lot happening in terms of documents which have been released in relation to Amount A in the coming months. So we've actually had 5 papers released in relation to Amount A through February, March, April, and May. With the OECD due to release further papers in the coming months for the constituent parts of Amount A. The Amount B document is due to be released at the end of 2022, but as notified by the OECD, we're expecting a public consultation will occur on Amount B in 2022. And so according to the plan for Pillar 1, we're also expecting some point a multilateral convention which will be the overarching implementation framework in order to implement Amount A. The inclusive framework will seek to conclude the text of the multilateral convention and its explanatory notes sometime in 22, so that it could be potentially open for signature at some stage in 2022, but we may have some slippage there potentially. If we can go to the next slide. Just a reminder about the architecture of Pillar 1, so let's move to the next slide. Really, we have three components of the Pillar 1. We have this new amount A on the left-hand side, and amount A is where a market jurisdiction may be eligible for an amount A net income from a multinational through a new Nexus test that is being developed. And so, for example, example could be a digital company at the moment that has no current physical presence or a permanent establishment under Article 5 of the Treaties in a country, and is therefore not taxed in that jurisdiction under the current income allocation rules. However, under the new amount A multinational will need to allocate a percentage of its global profits to that jurisdiction if the multinational is within the scope of amount A, and if there's a revenue nexus with a country. So let me point out several features of amount A that I think are important. The first is amount A is calculated on a global consolidated financial accounting basis. That is, it's calculated on a single group entity basis using the consolidated financial accounts and not on a separate legal entity basis as per the current transfer pricing rules and our current corporate income tax system, which obviously taxes on an entity by entity basis. This is a group calculation. The second, the allocation of amount A is based on a formula. And so it's 25% of profits above 10% adjusted profit before tax. So it's not calculated using current transfer pricing rules to allocate profits. It's calculated based on a formula, which I'll walk through a little bit later. And the third unique thing from my perspective is this new nexus for amount A, which is based on a revenue connection to a market jurisdiction and is not limited to a physical presence test as per Article 5 of the tax treaties. And so the purpose of amount A is to reward a market jurisdiction where a multinational is receiving profits through a direct relationship with the users and consumers in that market jurisdiction, i.e. it's getting revenue. So it's a revenue connection, not a physical connection. On the middle, we have amount B, and amount B is the proposed fixed return for all marketing and distribution entities. It's proposed as a simplification in order to reduce compliance and controversy connected to setting transfer prices for these sorts of entities. And so it's proposed the fixed return would be set with reference to the arm's length principle, but that it would be agreed as a fixed return as opposed to multinationals having to go away and benchmark and transfer price, which may create extra work and compliance and audit work for jurisdictions. It will be an agreed upon fixed return agreed by the inclusive framework. On the right-hand side, tax certainty. In the July and October inclusive framework statements, it makes it clear that in-scope multinationals will benefit from dispute prevention and resolution mechanisms, which will avoid double taxation for amount A, including all issues related to amount A. And what's specifically called out is those related issues include transfer pricing and business profits disputes, and that they would seek to do this in a mandatory and binding manner. However, I also note the October statement from the OECD states that there is an elective binding dispute mechanism will be available for issues related to amount A for developing countries that are eligible for a deferral of their Beps Action 14 peer reviews and have no or low level of MAP disputes. So it's clear there is much more work to be completed and agreed by the inclusive framework before the multilateral convention can be signed by the inclusive framework members. Next slide, please. I'm pointing out here a few of the key points that were made that came out of the OECD October 8 statement, 2021 statement in relation to the framework and the political agreement on amount A and Pillar 1. So as can be seen on the slide, there are some very important quantitative elements that were agreed in the October statement. Firstly, scope of amount A. And as per the October statement, scope is quantitative based and comprehensive in nature. So it will Amount A will apply to multinationals which have euro 20 billion of revenue or greater, and a profit threshold of greater than 10% profit before tax. But there are exclusions from the scope of Amount A for financial services and extractive companies. Nexus, in the October statement, there is a de minimis revenue thresholds are proposed, and these thresholds are euro 1 million revenue for countries that have a GDP of greater than euro 40 billion, and euro 250,000 revenue for countries that have a GDP of less than euro 40 billion. So if you are a multinational in that jurisdiction, greater or less rate, you need to have revenue connected to that jurisdiction of those thresholds in order to be for that market jurisdiction to be eligible to receive the new Amount A. Profit allocation, the October statement notes that profits will be allocated to a market jurisdiction only above 10% profit before tax threshold, and then only 25% of those profits. So what it's reallocating is some of the residual profits from a multinational, not all of its profits. And tax certainty I've already talked about, and on implementation I've already noted that this will be through a multilateral convention, will be used to implement Amount A. And there'll be no newly enacted digital services taxes or other relevant measures will be imposed on any company from the date of the October statement, which is the 8th of October, and until the earlier until the earlier of 31 December 2023, or the coming into force of the multilateral convention. So those are just some key parameters that were agreed in October. But what's happened since then? If we can go to the next slide. Well, quite a lot has happened since then. We've had a number of new documents that have been released by the Secretariat of the OECD, and I think it is important to note that these documents have been released as Secretariat documents and not inclusive framework papers. Accordingly, inclusive framework members have not yet agreed to the contents of these papers. So the first one that was released was on the 4th of February 2022, so just a few months ago, in relation to the draft rules on Nexus and revenue sourcing. And under the draft rules, the Nexus in a particular jurisdiction is determined based solely on revenue to the final, arising to a sale to the final customer. And revenue is to be sourced on a transaction by transaction basis using reliable indicators, and I'll comment on that a little bit further. Tax base is the next paper that was released by the Secretariat on the 18th of February 2022, and under the draft rules, the tax base is the adjusted profit before tax on the scope of multinational of an in-scope multinational group. So the determination of the Amount A, we have to take the adjusted profit before tax, and so that's starting with the financial accounting profit at a group level, and then making specified book to tax adjustments and deductions of net losses. Scope is the third document, which was released on the 4th of April 2022, and this talks about covering off the threshold test that I mentioned earlier. So the global revenue test is total revenues of the group which are greater than 20 billion. And the profitability test is where the pre-tax profit margin of the group is greater than 10%. And there are three tests to test the profitability of a multinational to make sure it's in scope. Segmentation and the extractives and financial services carve-outs are dealt with in separate documents. The last two documents relate to the exclusions from the scope. So the fourth document is the Extractive Exclusion, which was published by the Secretariat on the 14th of April 2022. And it goes through how extractive companies will need to ensure that that all of their income is excluded, and goes through how segmentation will work for the extractives exclusion. And similarly, what released last week on the 6th of May 2022 was the Regulated Financial Services exclusion. And this paper confirms the scope of Amount A will exclude the profits from regulated financial institutions, which are defined in that document. I will not speak further about the extractives exclusion nor the regulated financial services exclusion, because these are quite specific to these industries. If we could move to the next slide, please. So let's now turn to amount A. And on the next slide, this is to give you an overview, and this is subject to change, obviously, but amount A includes understanding what groups are in the scope of amount A and which are not. And so that's the first box on your left-hand side, which includes assessing whether a group passes the threshold tests and applying the carve-outs for extractives and regulated financial services. So in the first box, we're really taking multinationals and confirming that they are in scope, that they have revenue of greater than 20 billion, and that they have profits, a pre-tax profit margin of greater than 10%. And then we would look to apply any carve-outs related to those exclusions. It's then calculating the tax base for amount A, applying the proposed adjustments, and carrying forward losses and any segmentation if it's required. And that's the middle box, the right-hand side top box. It's then a matter of calculating the amount A, which includes allocating income above the adjusted profit before tax and allocating 25% of that. And that's the bottom left-hand side box. The Nexus sourcing block in the middle of the bottom deals with confirming which jurisdictions have Nexus for the purposes of amount A and where the revenue is sourced to those jurisdictions. And then the last box is dealing with the issues of which jurisdictions will surrender, i.e. pay amount A, and early certainty in the filing process. And as yet, much of this has yet to be finalized by the OECD, but the thinking is, number one, am I in scope? Is this company in scope? Number two, I have to calculate the tax base for amount A. Number three, I then have to quantify it and take the residual profits, 25% of the residual profits above 10%. Then I have to confirm which jurisdictions have Nexus and apply the revenue sourcing rules. And then lastly, I have to find my paying entities and move through the tax certainty and filing an administrative process. That's broadly how amount A works at a high level. We could move to the next slide, please. So in relation to the scope of amount A, let's just quickly walk through each of these pieces to give you some background. You can see from this box here, in relation to amount A, we had the consultation document, as I mentioned, which was recently released, and there are a few interesting points to note from this document, which I'll highlight to you. There are excluded entities in relation to amount A, and are similar to Pillar 2, in that excluded entities include government entities, non-profit entities, pension funds, investment funds, ultimate parent entities, and real estate investment vehicles that are an ultimate parent entity. So we have excluded government and other entities. And then we also have the extractive carve-outs that I've already mentioned, the extractive and financial services carve-outs. So we exclude and carve out those entities, and then we apply the threshold tests that I mentioned. And so we apply the revenue threshold test to see whether we have revenue of total revenues of greater than 20 billion euro, and we apply the profit tests. And there are 3 steps to that, which I'll go through next, in terms of understanding whether a multinational has profits above 10% of adjusted profit before tax. These rules also have a business reorganization rules, and they also have an anti-fragmentation rule in the public consultation document. And the anti-fragmentation rule is an anti-abuse provision that the Secretariat is considering where there's been an internal fragmentation or restructure which potentially will reduce the threshold so that multinationals are not in scope and are actually below the revenue threshold. So it is considering whether there needs to be an anti-fragmentation rule to stop any multinationals avoiding amount A. And this also includes a principal purpose test as part of the internal fragmentation rule. If we go to the next slide, please. In terms of the profit test, what this example shows is that there is an averaging mechanism to test the pre-tax profit margin, and so the test for profit is the pre-tax profit margin. The scope test for profit is the pre-tax profit margin, and the Secretariat is potentially proposing 3 different tests to apply against a multinational. The first is that the pre-tax profit margin is above 10% for the current period that it's being tested the current year. The second is that the pre-tax profit margin is above 10% for two of the immediately prior 4 periods. So it's trying to ensure that the two of the immediately preceding 4 periods in the current year are also above the profit margin requirements of 10%. And then the third test is the average pre-tax profit margin of the current period and the preceding 4 periods is above 10%. So it's testing the current period, the preceding periods, and then the average of both the current and the preceding periods as the 3 tests. And as you can see from this example, all 3 tests will need to be passed in order for the multinational to pass the profit threshold test and be in the scope of amount A. We can move to the next slide, please. So moving to the next block here this is the tax base and accounting for losses. So in terms of the tax base, a couple of interesting points came out of the public consultation paper on tax base. So the OECD is asking multinationals to make several adjustments to its global consolidated tax base in order to arrive at an adjusted profit before tax. And these adjustments are similar to Pillar 2, but probably slightly less in number. So there'll be an exclusion for current and deferred tax expense. Dividend income will be excluded. Equity gains and losses income will be excluded. There'll be policy disallowed expenses excluded, and restatements for prior period areas will also be excluded as well. So the OECD is saying that in order to get to your tax base and your PBT, your profit before tax number, you need to adjust that for the items that I've mentioned. The OECD is also allowing both pre-implementation regime losses and post-implementation regime losses in as well. So for pre-regime losses, the carry forward range indicated in the public consultation document is 2 to 8 years prior to the implementation. And for the post-regime losses, the amount A regime loss carry forward is 5 to 15 years. So obviously the inclusive framework will be working hard to reduce those ranges down to specific numbers for pre-regime carry forward losses and post-regime. We move to the next slide, please. As you can see on this is an example of the adjustments that I talked about here. And in this example, you can see, for example, that there are certain items which will need to be excluded for the post-adjustment on the right-hand side. And that includes dividends, gains from the sale of equity interests, for example, or profit and loss from equity interests are excluded from the calculation of profits, as are fines as well. And so you get to an adjusted figure, and this will be your adjusted profit before tax. And so, as I've mentioned here, multinationals will need to consider these adjustments to revenue and also to fines and policy disallowed expenses as well. On to the next slide, please. In terms of losses, as noted above, this is an example again for you. Pre-regime and post-regime losses will be allowed to be carried forward, as can be seen from this example. And this example just shows where there are losses which are disallowed outside the time periods currently indicated. And as I've mentioned, pre-regime losses will be carried forward in the range of 2 to 8 years. For post-regime carry forward losses in the range of 5 to 15 years. And again, as I mentioned, these ranges will be worked on by the OECD in order to confirm the exact length of time for allowable pre and post-regime losses. Next slide, please. In terms of the quantum of amount A, as I've mentioned previously, this is calculated by taking 25% of the profits above 10%, the adjusted profit before tax. So this is then allocable to the eligible market jurisdiction. So we're not taking all of the profit of the multinational, we're only taking the profits above 10% adjusted profit before tax and only 25% of that above range profit. So we're really taking the residual profits of those multinational entities, and they will be taxed at the eligible market jurisdictions. Let's move to the next slide, please. Now I'm moving on to applying the revenue source. So what I've been through so far in these examples is scope, and we've talked about the profit threshold test. I then moved on to tax base. I then talked about the adjustment and the carry forward losses. Then I moved on to the quantum of amount A, which is taking the profit, 25% of the profits above 10% adjusted profit before tax. Now I'm moving on to who's going to receive the new amount A. So now we're going to apply the Nexus rules and the revenue sourcing rules to see which market jurisdictions will receive the new amount A. And as noted above, the public consultation paper on Nexus and revenue sourcing focuses on aspects of sourcing the revenue for the purposes of applying the Nexus test. And actually these rules are quite complicated. So for the purposes of the model rules, the term revenues refers only to revenue derived from third parties. So here we're dealing with third party revenue, not intercompany revenue. The paper proposes a transaction by transaction approach where multinationals will need to source revenue by first identifying the category of revenue, i.e. is the revenue connected to finished goods? Is it connected to services? Is it connected to intangible property or real estate, etc.? So we first of all, we find the category of revenue, and the paper, the public consultation paper notes that the transaction is categorized based on the ordinary character of the revenue. A transaction comprising of different elements that fall under more than one category is characterized on its predominant character. And the paper goes through what predominance means. After we've identified the category of revenue, we then need to identify the transactions connected to these categories, and multinationals will need to categorize transactions to each of the categories. And then thirdly, multinationals will then need to apply reliable indicators to source the revenue to a particular market. And in terms of the reliable indicators, these are used to ensure that revenue is sourced to the market where the final customer is located. And so the final customer is defined as the person acquiring the good, the service, or the copyright for consumption or use. And so that's important to understand. We're sourcing revenue to where the final customer consumes it. And in order to allocate all the revenues, the draft rules provide that when the covered group does not have the information available to apply an indicator, and no allocation key is available, then the covered group must use the global allocation key. And so the consultation document indicates that the global allocation key will allocate revenues based on a ratio such as a share of the final consumption expenditure or GDP of a country, subject to further development. So you're taking the ratio of where you think of where that revenue is, that country's GDP versus global GDP, and taking a proportion of that, and that proportion of revenue will be sourced to that jurisdiction. And that's on the basis of when we can't find the revenue, we have to apply this global allocation key as a backstop. So in terms of applying the Nexus test, this will apply as follows. For jurisdictions that have a GDP of greater than €40 billion, the multinational must have revenues of more than €1 million from the jurisdiction for that jurisdiction to have a nexus to receive amount A. For jurisdictions of less than GDP €40 billion, the multinational must have revenue of more than €250,000 from the jurisdiction to have nexus. So if we move to the next slide, please. This just shows you the categorizations that I mentioned. And so what the OECD paper says is, in order to source revenue, we first of all have to look at the different categories of revenue. So we're going to look at, we're going to figure out whether the multinational has sales of finished goods, revenues connected to components, revenue connected to services, revenue connected to digital goods or intangible property or real property or government grants or non-customer revenue. And there are also a number of subcategories not listed here. And so for each category and subcategory of revenue, multinationals provide, the draft rules provide an indicator to identify the source of the revenue, which I've noted here on the right-hand side. So an indicator is considered reliable if it satisfies two requirements. And so multinationals are going to have to prove this. First of all, they're going to have to prove that the indicator that must produce a result that's consistent with the source rules for the transaction. And second of all, the indicator must meet at least one of the following reliability tests. First of all, it needs to be, the indicator potentially is relied upon for commercial purposes or to fulfill a legal or regulatory or other related obligation. It would need to be verified by information by a third party that has collected the information, or that indicator and one other indicator get to the same jurisdiction, or the indicator is verified in another matter that is functionally equivalent. So multinationals will need to prove the type of revenue and prove the reliability of the indicator. So that means that they'll need to keep very detailed records and have an internal control framework to convince tax authorities that the approach to allocating revenue is correct and accurate. So this part is actually quite complex, and it's not finished yet, and it's still up for review by the inclusive framework. Next slide, please. Next, Amount A is allocated to jurisdictions based on a pro rata basis. So revenue is the allocation key. And if country, for example, country X accounts for 10% of a multinational's revenue, it would be allocated 10% of the total allocable amount A. However, it is important to note that the October OECD statement does note that where the residual profit of an in-scope M&E multinational are already taxed in a market jurisdiction, a marketing and distribution profit safe harbor could apply to cap the residual profits allocated to the market jurisdiction. And so for further work will need to be undertaken on the design of the safe harbor, including the scope of the safe harbor and what the threshold for that safe harbor will be. So what this really means is what's being contemplated by the inclusive framework is if you have a multinational which has very high profits in that market and still receive an amount A, then this potential marketing and distribution profit safe harbor could limit or even eliminate the amount A allocable to that jurisdiction because there are already residual profits in that jurisdiction. And so that's still in design, and no public consultation paper has been provided on this point yet. If we move to the next slide. So now that we've been through scope, am I in scope? Is the company in scope? You've calculated the tax base. We know what the quantum of amount A actually is. We know what jurisdictions are now going to be receiving the amount A, the Nexus jurisdictions, where we've sourced revenue, and that we've allocated that revenue on a pro rata basis based on a revenue allocation key. And we've applied the marketing and distribution safe harbor. Now we have to find which entities or jurisdictions are actually going to pay the amount A. So as yet, there has been no document released in relation to the elimination of double tax. However, there are several important points that came out of the October statement from the OECD. So this first relates to identifying the paying entities or jurisdictions from those that earn the residual profits. And there are several questions, and we saw this in the blueprints, the blueprint which came out for Pillar 1 in October 2020. The question is, will we identify the paying entities? Will this be based on a quantitative basis, i.e. the most profitable entity should pay? Or will it be more qualitative, which is, for example, will it be based on transfer pricing, concepts such as ownership of intangible property, or entities which are connected to markets? And we don't yet know what the criteria will be for being a surrendering or paying entity or jurisdiction, and what profit level indicators should be used. We don't know that yet. And it's possible it could be revenue, for example, could be tangible assets, payroll. We don't yet know the basis for that. We also don't know yet, it's not yet decided how the allocation will actually occur if you've got more than one paying entity. So say I have, say a multinational has 10 paying entities, which entities pay first, second, third, or do they all just pay a pro rata amount based on their profitability or contribution to amount A? So we don't know the order in which paying entities will actually pay. And one thing has been noted in the OECD October statement, though, is that the exemption method, double taxation, will be managed through either an exemption method, so a paying entity will be able to deduct the sum of amount A profit paid from its own taxable income, or a credit method. Paying entity receives a credit against its own tax payment due for the amount of tax paid in another jurisdiction. So that's one thing that has been mentioned in the October statement, that jurisdictions and multinationals will have the option of using an exemption or a credit method in order to reduce or eliminate double taxation. Let's move to the next slide, please. In terms of the administration, again, we have not yet had a public consultation paper in relation to the administration, nor have we had it in relation to the multilateral convention. It has not yet been released. So confirmation on the exact nature of the administration of amount A is yet to be confirmed. So we're not yet aware of the filing process. Is the payment process government to government? What documentation requirements? Does this need to be audited? What does the payment? When does the payment occur? Is a physical payment actually required? We're not yet aware of that. If we could move to the next slide, please. In relation to dispute resolution, again, we're waiting for the OECD in order to release a paper on tax certainty for amount A and tax certainty for beyond amount A. And this is the proposed enhanced tax certainty process that will apply to amount A and beyond. And there are still many important questions not yet answered. And we're hoping that the public consultation papers will provide answers to some of these, which include, for example, how did the dispute prevention and resolution panels work? Is the early certainty process mandatory? When does the process start? How many panel members are there? What is the timing to undertake the review process? What is the process to challenge a position? And what is the time frame to resolve? What is the process for developing countries? What does the developing country process mean in detail? Is there an appeals process? What if an adjustment is made and accepted? How is the adjustment made? Is it retrospective or prospective accounts or tax return? And so there are a number of points that we'll be looking forward to receiving in relation to tax certainty for amount A and tax certainty for beyond amount A. So just before I move to the next slide, so what I've taken you through very briefly is scope, and as we've mentioned with scope, that has both entities which are excluded from the scope of amount A. For example, government entities. We also have carve-outs for financial services in the extractives industry, and then we use thresholds, revenue and profit thresholds, to confirm whether a multinational is in the scope of amount A or not in the scope of amount A. We then have tax base, and we get to an adjusted profit before tax in order to calculate the amount A. And so we have to apply the adjustments, and we have to apply potentially also pre-regime losses, which are carried into the amount A regime, and post-regime losses to carry forward as well. And then that allows us to calculate the amount A through the adjusted profit before tax to get to the quantum. And then we're going to adjust the quantum by saying we're going to take profits above 10% adjusted profit before tax and only 25% of that. And then we're going to, from there, we're going to confirm which jurisdictions have Nexus. And we're going to do the Nexus test. And those multinationals which have €1 million worth of revenue in jurisdictions which have a GDP of greater than €40 billion will have a market connection, a Nexus, and where we have a Nexus, we have €250,000 worth of revenue for jurisdictions less than €40 billion. And so that's our Nexus, and we're going to source revenue, as I mentioned, to confirm that we're connected to these markets and we have revenue in these markets through these revenue sourcing rules. which will require multinationals to understand the categories of revenue and then apply the reliable indicators to say, yes, I've got revenue in this particular jurisdiction. Where they cannot use reliable indicators, then they'll have to use these allocation rules, which are based on GDP allocation, GDP rules, because they cannot source the revenue specifically to a jurisdiction. There's this backup test. And one of the important things about the revenue is all revenue under the public consultation note says all revenue needs to be sourced to a jurisdiction. So we either apply the reliable indicators or the broader, the backstop rules, the allocation rules to do that. And then lastly, we will then find, now that we've found which jurisdictions will be receiving Amount A, we need to allocate it to them using this revenue as the allocation key, but then apply the marketing and distribution profit safe harbor to confirm whether they need to be paid or there's already residual profits in the market, so that no payment of Amount A is required because the threshold for that safe harbor has been surpassed. And then we're going to confirm which jurisdictions are going to actually pay the Amount A. As yet, we don't have rules in relation to that from the OECD Secretariat, but we'll be looking forward to rules to confirm what profit level indicators, for example, will be used to confirm which jurisdictions should be paying entities. And how that allocation process should occur where you've got more than one paying entity. And then we're still waiting on rules, as I mentioned, for the administration of the multilateral convention and the filing process, and also the tax certainty process. So as you can see, this process is still very much being built by the inclusive framework and the OECD. Let's move to the next slide. Just in terms of next steps, as I've already mentioned to you, there have been upcoming requests for input from the OECD in terms of the papers that we've been through, and so there have been a series of short public consultations in a written procedure in connection to the papers that I've already mentioned, such as through scope, nexus and revenue sourcing, tax base, the extractive exclusion, and now recently released is the financial services exclusion. And as I've mentioned, there are a number of upcoming papers that we're expecting in relation to the areas which I've noted are still under construction, such as the marketing and distribution profit safe harbor, and also in relation to segmentation, unilateral measures, tax certainty for Amount A, tax certainty beyond Amount A, elimination of double taxation, and administration. So there'll be a series of continuing public consultations on Amount A in the coming months as well. As I mentioned also, the Amount B document is due to be released at the end of 2022. I haven't actually touched on Amount B simply because as yet, we really haven't had much update on Amount B, and we're still looking, and we're looking forward to a public consultation on Amount B in mid-2022. We were hoping to receive some further guidance in relation to what the scope of Amount B, the types of marketing and distribution entities that could be within the scope of Amount B. And we're also looking forward to understanding how the fixed return for those marketing and distribution entities will also be dealt with, and whether there would be any variation in returns to the fixed return for marketing and distribution entities which are in different industries, which are in different geographies, in different regions, and potentially also are functionally different. So have more functions versus less functions related to marketing and distribution functionality. So we look forward to understanding more about Amount B. And then, as I've mentioned, we're also looking forward to receiving the multilateral convention and what that means in terms of countries seeking to sign that document and its explanatory note, which we are looking forward to sometime in 2022, and then potentially a signing ceremony sometime in 2022, but we don't know when exactly that will be. And as noted, there are still a number of papers to be released on Amount A, so the exact timing is not yet sure exactly when the process of Amount A will be finalised. and therefore ready for a signature sometime in 2022. That's it from me in terms of a quick run through, Kaylin and Renata, in terms of amount A and amount B and pillar 1. Hopefully that was somewhat helpful in terms of where we are, in terms of each of the components and the broader overview and the next steps. Thank you.
Thank you very much, Matt, for that presentation of the overview on the pillar 1. Danny, can you keep the slides up, please? There are no questions in the chat box. However, if you do have any questions and you want to type them in the chat, please feel free. Also, if you want to raise your question verbally, please raise your hand. Now is your chance to speak to or ask your question to Matt. So let's give people a bit of a chance to gather their thoughts, and we'll see if there's any questions that come forward. Thank you. I don't see anyone jumping at the opportunity to raise their hand or type questions.
Good morning. Actually, the option of raising hand is not there. Can I ask a question, please?
Of course, please go ahead.
Yeah. My question is that who would be auditing these global profits, and whether this would be subject to scrutiny in the market jurisdictions also? In all market jurisdictions. I mean, one entity, let us say, is having presence in maybe 100 countries, and this would be audited in a particular country, and then the residual portion of the amount A would be allocated or say would be shared with many market jurisdictions. If, let us say, one market jurisdiction is challenging, so can this be scrutinized by that particular country also?
Yeah, I think it's a very good question. As yet, we don't have guidance from the OECD Secretariat in relation, or the inclusive framework in relation to how the early certainty panels will work, nor the dispute resolution panels. But I think what we would expect to hopefully sort of see is that there is a mechanism by which the key components, such as the scope rules, the tax-based rules, adjustments, losses, the allocation itself, the application of the marketing and distribution profit safe harbor, etc., will all be subject to potentially an early certainty process where multinationals seek early certainty so that they can agree those points with paying jurisdictions and market jurisdictions as well. I think an important point which is coming up is exactly how the early certainty, what constituent members will be of the early certainty panel and the dispute resolution panels. And so, for example, it's not yet clear, but we hope for clarity in terms of how many members of the market jurisdictions will be part of the dispute resolution panels. But I think you would expect that there would be a mechanism by which market jurisdictions will be able to question or raise objections through that dispute resolution process. But the exact nature of that in the panels, we don't yet have that information, but we hope to have some guidance on that in the coming months.
Thank you.
Thank you very much, Matt. We have a couple of questions in the chat box. The first one is, how many MNEs would be subject to amount A taxation in the world?
Yeah, so at the moment, it's roughly, and it depends, I think it will depend on these averaging mechanisms applied, but roughly, let's just say it's about 100 companies of the largest multinationals in the world will be subject to amount A. And I think the rationale for that is the thresholds of 20 billion euro is very, very high, which reduces the number of multinationals down. And then there is a proposal that 20 billion euro threshold will be reduced to 10% to 10 billion euro from the timing of the start of the Amount A regime, and then we'll see what happens from there. But initially, it's 100 plus multinationals of the very, very largest multinationals, which are potentially subject to Amount A, and then that will broaden out to a broader group once the threshold comes down to 10 billion euro.
Great, thank you. We have another question in the chat, and it says, accounting standards vary across regions. How will this be taken into account for computation? Since MNEs have very varied businesses, how would segmental analysis be carried out for common costs?
Yeah, and I think that's going to be, I think that's a very, very good question. It's going to be complex. I think you will sort of see in the tax-based paper, there is a similar approach taken to the tax-based calculation for Amount A in terms of there are accepted accounting standards, so which are effectively IFRS GAAP accounting standards. And then the adjustments which are proposed, such as in relation to the gains and losses on equity investments, dividends, etc., are supposed to reduce some of those differences. But I think from a simplification perspective, there was a viewpoint, I think there probably is a viewpoint that we don't want significant harmonization adjustments within a consolidated group where you're applying JGAAP and KGAAP and different forms of GAAP, but you're actually consolidating to US GAAP. There is a view that there shouldn't be too many adjustments because that creates unnecessary complexity. So there is a simplification mechanism where there is a limited amount of harmonization requirements, but there is also in the tax-based paper a note where there are really distortive differences. There is potentially, which I can't remember the exact number, but it might be 10% impact on the adjusted profit. Then there would be this adjustment process to harmonize for very large differences in accounting treatment. So there is a mechanism in there which is proposed to reduce those differences. In terms of segmentation, that's a really good point. That's always been a really difficult issue, because I think when you're looking at segmentation, in many cases, the segmentation at a global consolidated financial accounting perspective, it really only looks at the segmentation at a revenue level, and then potentially at a gross profit level, but not potentially all the way down to this profit before tax or adjusted profit before tax. And so when it's alluded to in the 7-step approach, there's a 7-step approach for segmentation for extractives, and a 7-step approach for financial industries to get to segmented profits potentially to carve out extractive segments which are excluded, and to carve out financial services segments which are excluded. There is this process of allocating, of recognizing that there'll need to be an indirect allocation of costs. Now, there is not a lot of detail yet in relation to how that the allocation of indirect costs will be allocated and what mechanisms should be used, because the segmentation paper is still not released. So that will be a complex issue, and one of the reasons why I think the initial scope of Amount A, which was really only for digital companies and consumer-facing businesses, has now become across all businesses, is to reduce the segmentation complexity of allocating indirect costs and revenues across different segments. So we look forward to the segmentation paper to understand more about how indirect costs will be allocated.
Thanks, Matt. Another question is, would there be any changes to domestic law or the treaties, or the pillar would be implemented via only based on the convention?
Yeah, and I think that's, again, we're looking for guidance from the OECD in relation to that, but I think there probably is a recognition that the multilateral convention is required for the purposes of Amount A, and that's because there'll be many jurisdictions which don't have treaties with each other, and so they'll need to use this as the basis for the elimination of double taxation and the use of the credit mechanism potentially. But I think there is also a recognition that there may be a requirement to implement this in domestic law, and I think one of the things is particularly where jurisdictions will need to apply and may even treat the new Amount A as a separate type of tax. Who knows? And so I think there will be provision and some guidance provided by the OECD in relation to domestic rules implementation as well.
Thank you. Another question that's appeared: how can we determine the component category of place of delivery to the final customer of the finished goods? How to make the difference between finished good category and component category?
It's a really, really good question, and I think we could spend another 3 hours talking through just the revenue sourcing rules, and the reason is one of the reasons the OECD Secretariat has suggested you need to categorize is because the indicators are different. And so the indicators to say that I've sourced revenue to a final customer for a finished good is different to the indicator for a component, and it's different to the indicator for services, and it's different for the indicator, et cetera, et cetera. And so one of the things, the challenges I think multinationals will be faced with is particularly where they're using third-party resellers, is where they sell to a third-party reseller in a market, and then the reseller says, well, I'm not telling you where my final customer is. That I think will be very challenging, and that's why I think the OECD has suggested that if you cannot find an indicator because the third-party reseller will not tell you, then you need to use the GDP allocation rules as the backstop rules. And I think we'll find that many multinationals will actually have to use the allocation rules because they cannot get information from third-party resellers.
Thank you. Another question has to do with accounting years, which can also be different around the world, and may need harmonization as well. Is there anything from the OECD on this?
Not yet in terms of the start date, because I think the start dates are still not yet decided, and I think there is a recognition that 30 June versus there may need to be part year adjustments or part year rules in terms of if you've got a 31 December year-end US multinational, but you're actually applying 30 June or 31 March in certain jurisdictions, there will need to be harmonization. But remember again, this will be at a group consolidated financial level, and ultimately we'll use the group consolidated financial accounts, and those intercompany transactions will be eliminated for group consolidated financial accounts.
Okay. And one last question that appeared in the chat: when an MNE enters into a new jurisdiction, generally it makes losses the initial few years, but with this new formulary approach, the jurisdictional country will get some revenue if the Nexus threshold is satisfied, despite the MNE making losses in that jurisdiction. Appears to be contradictory. Your views, please.
Yeah, and I think not much I can say to that except to sort of note that yes, there could be cases where under the current transfer pricing rules, which remember are on an entity by entity basis, and you might have a loss. But remember again, we're applying the Amount A at a group consolidated financial level. So you could have a marketer distributor or a manufacturer in a loss situation, but you've got a revenue connection and actually have an Amount A which is due to that jurisdiction as well. And so that's certainly possible. And I think that's what the inclusive framework potentially is trying to do here. Is to actually provide more revenues to market jurisdictions where they feel where it's felt that the current rules don't currently provide enough revenue and enough taxing rights to that jurisdiction. So there is a difference, and again, transfer pricing is at a group, an entity level. Amount A is at a group level, so it's a different approach to taxation.
We have one other question that's appeared. How could tax authority ensure that revenue sourcing data collected by Eminence is complete and accurate?
Yeah, and I think this is an area that the OECD recognizes will be very challenging. And actually, the paper, the public consultation paper, makes some interesting comments in relation to that, and that it sort of says what a multinational will need to do is to demonstrate that it has intelligent internal processes and controls, so that they can demonstrate compliance at a control level. And I think this is an area where I think jurisdictions are going to be very interested. Not just that, I think jurisdictions will be interested in all of this because it could mean more income. But I think in terms of reviewing the quantum of amount A due to that jurisdiction, and number two, the revenue connection, I think will be of great interest. And I think it's going to be challenging because I think multinationals potentially may struggle initially to be able to source all of their revenue, and therefore may use allocation keys, the backstop allocation keys as the basis. As time goes on, we would hope that multinationals are much more accurate and are able to source their through their systems, are able to confirm even through third-party resellers where their revenue, where the final customer actually is. But my sense is that it will take time for multinationals and for jurisdictions to get into a rhythm and a review process to ensure that that's in place, that there are robust processes and controls in place.
Thanks, Matt. We've run out of time, so thank you very much for your presentation and for all of your questions. I know that there are quite a few other questions, so feel free to contact us. We're happy to respond to your questions. As you can see on your screen, there's a QR code for a survey, so if you could provide feedback on this workshop, that would be much appreciated. A link has also been provided in the chat box. So thank you very much for attending the session. Friendly reminder that the workshop on Pillar 2 is being held on Wednesday, the 18th of May. Same time, same channel, same Zoom link to use that you accessed for this workshop. So please use that. Also, we just wanted to remind you that the OEC ADB, along with some other regional tax bodies like CATA, PITA, and SEGATAR, are organizing a regional consultation on June 2nd. And email invitations went out yesterday for that event. So please check your inboxes and sign up to register for that event. So thank you very much for attending this workshop. Wish you a very lovely weekend, and we will see you next Wednesday. Thank you.
Thank you.